What a delight to have you back on ET now in a different avatar. So congratulations on the move.
Thank you, Nikunj.
Characterize the market environment for us at these levels, at global level. What do you think markets are pricing in? Are markets already pricing in a disorderly exit of Greece?
Nikunj, I don't claim to be either a political expert on Greece, which most, unfortunately, equity analysts today seem to have become, nor do I claim to be an expert on European equity. But I think the markets are sort of pricing in a lot of negativism at this point of time. And I think there are issues that are there in the global market. Let's face it. One is that Europe is going to grow very slowly, either at 0% or negative. Greece is going to be a problem because we've got political uncertainty in Greece. They don't want to sort of agree to any of the austerity conditions. They are significantly over-leveraged. But Greece is just 2% of European GDP. So, I mean, I think we are extending it a little too much. The US, again, people are worried that in the run-up to the elections and, from the elections to January 1st, when, there's a lot of fiscal consolidation that needs to happen, there will be problems. But I think the opportunity actually is the fact that equity markets are pricing in so much of negativism that there could be a real opportunity to find deep value in these markets and sort of start taking exposure to equity, because in the long run, I'm sure you'd sort of remember the days that you got equity so cheap.
But are we living in dangerous times? Greece could have a new election. France and Germany may not agree. US economic data of late has been poor. That is your Western story. If you look at things on your right-hand side, Japan is still in a mess. China seems to be slowing down. And if you look at India, India also has their own set of macro problems. So what makes you bullish on equities?
Okay, let me get back to the India story specifically, because see, as insurance companies, we can be long only India. So I think the India story is very important for us and our policy holders. There are a whole set of negatives that are there in the India story, and I think, everybody has been talking about it, and you must have been hearing about this day in and day out. We're talking about these multiple deficits that we have: the current account deficit, the fiscal deficit, the liquidity deficit, the governance deficit. People have got fascinated by this deficit word nowadays. But having said that, I'm not saying that we need to be running away from these problems. There are these issues that we are facing. But let's look at India, from a much longer perspective. There are a couple of things that I think we have to remember. One is that India is not an export-dependent economy. Just 15% of our total gross domestic product is exports, right? If you break down the composition of those exports, 5% goes to the US, 15% goes to Europe, 55% goes to Asia, and the rest of it to the rest of the world. So we are not overly dependent on whether Europe slows down or the US slows down. Two, if you look at the nature of those exports, there is a large part of it that's manufacturing exports. We do a lot of service exports also in terms of ITs, and we do a lot of gems, jewelries, and so on. But manufacturing exports could get impacted because of the US and Europe. And that we are seeing in terms of the fact that output numbers are falling. So we had negative 3.5% IIP growth, possibly a little bit because of the fact that those markets are growing. But still, 85% of the total GDP is actually domestic consumption. I think that's one thing which we need to remember, and I don't think we need to get too worried about that. The second thing is that, demographics is clearly in our favor. The consumption economy, and if you look at private consumption in India, private consumption in India has not slowed down in spite of whatever that has happened.
Why do you say that?
And I think, why do I think private consumption will not slow down? I think because it's the demographics that is helping us as far as private consumption is happening. If you look at fertility rates and plot fertility rates and how that will translate into consumption, I think close to 2030, 2040, India will still have a very, very strong consumption story. And I think that 85% of the GDP tends to get protected because of that. And therefore, I think, there will be opportunities in markets like ours, where you can find good growth stories. And especially in times like this, where there's fairly deep value in the market, I think it would be a good time for long-term investors to start, taking positions in equity. Thirdly, if you look at flows itself, because I think that's one thing that's dramatically determined how Indian markets move. For a global investor, he doesn't have too much of a choice left but to look at, good emerging market stories, because, he is worried about Europe, he is worried about US, though a little bit of money is going into US equity at this point of time. And therefore he will look to allocate into India. And you look at the numbers itself, in this year itself, we've had close to, I think, $9 billion come into India. If you look at a monthly average, it's something like 1.3 billion coming in every month. So there are people who are looking at, on a bottom-up basis, stories in India and investing into India. And if you've got the money and you've got a fundamental story, I think it makes for, a good long-term equity investing.
If you're so bullish on Indian equities, if I look at the sum total of DI data, they've been net sellers for the year 2012.
Yeah, I mean, if you look at the domestic asset managers, I think a lot of them have been hit because of, redemptions. And it's basically because of outflows from mutual funds and possibly insurance that has led them to be sellers, and not because they fundamentally think that the markets are, in a bad state and they need to exit equities at this point of time. And I think a lot of that is determined by the fact that, pessimism tends to breed pessimism, and the retail investor, thinks that, the whole world is, getting a more difficult place to invest, and therefore he is exiting. I mean, there's one thing I've seen, Nikunj, that most people tend to get into the market when markets are at its peak. But the best time to get into markets is actually when there is blood on the street, because, that's when you get deep value. And I think it's now that a lot more sort of informed investors are realizing that that is the right way to look at equity. Like, get in when there is deep value, when there's blood on the streets, stay invested for reasonably long periods of time so that you can capture the upside, and then, create wealth for yourself.
So for the year 2012, at a net level, you've been a buyer or a seller?
So we've been, I think, more or less neutral in terms of, a buyer and seller, depending on the inflows and outflows. But we've continued to buy wherever we had the opportunity to buy.
And for the rest of the year, would you be a buyer or a seller?
I think we would continue to be buyers in this market. In terms of our overall cash positions, we still have 9 to 10% cash, which we keep for opportunities. We don't have very, very large cash positions at this point of time.
So given the way how dollar index has moved, or how crude has cracked, the fact that global hedge funds are just throwing everything and anything, there is this fear trade which is making a comeback. Do you think the current panic is a good opportunity to grab bargains?
Yes, I think the current sort of panic, if you call it that, is a good opportunity to sort of look for good opportunities to invest. And I think I'd also like to focus on some of the positives, because see, we've unfortunately, everybody seems to be focusing on the negatives at this point of time, and that tends to build in a fear psychosis which says that it may not be the right time. I am not trying to predict what levels the market would be. The markets may still correct 5%, 10% from here, or they may go up 5%, 10% from here, but that's really not our business of trying to predict where the markets are. But our business is to try to identify good stocks so that investors will stay invested for the medium to long term, sort of make money for themselves. And if you look at some of the positives, I think some of the points that you made in terms of the fact that crude has come down significantly from something like 127 to a barrel to something like 111 to a barrel at this point of time. And you have to realize that for every $10 drop in the crude price, the current account deficit actually comes down by something like 10%.
But that is also getting nullified because of rupee.
Correct. That's point number one. Point number two, if you look at the rupee itself, I think the rupee has depreciated quite significantly, maybe 10% from March and 30% from the beginning of the year. And in my own view, I don't think, whereas the rupee may depreciate a little more from here, I don't think there is a very, very big reason to believe that the rupee will drop very dramatically. So I think we will actually tend to gain, with the oil price dropping so much. Two, I think the commodity cycle is slowing down, which is actually very, very good for us as far as imported inflation is concerned. In fact, I've been seeing reports from leading, global commodity producers saying that they are slowing down in their investments because they believe that the commodity cycle will slow down. And I think that is significantly good news for us. If you look at inflation itself, I think core inflation, even the last reported number of core inflation at around 4.8%, is clearly telling us that core inflation has dropped significantly and will get pegged at something like 5%. Food inflation is a problem, but if you look at the food inflation side, if you looked at the food grain production numbers, we actually hit record food grain production numbers, 245 million tons. I still remember just a decade back, if we hit 180 million tons, we would be very, very happy. We hit 245 million tons. Food inflation is a problem, but overall, I think inflation, 7-8% would be where I think it will peak and then, possibly start coming down. So, on many of these things, I think, the fundamentals are changing. The macros, are showing signs of having sort of bottomed out and will only improve from here. I think where the markets will take cheer from is when we see a little more happening on the policy front. And I think there is a whole lot of stuff that has been done, especially if you look at the attempt to attract dollars into India. Both the RBI and the government have done a whole set of steps, including, restrictions on exporters and freeing out, rates and stuff like that to attract dollars into India. So there is, sure, but, essential steps that are being taken as far as on many of these policy fronts. A lot more needs to be done. I think as we get closer and closer to, 2014, I think there will be, a lot more acceleration in this process. And that, I think, will be actually the first signs of, the equity market saying that, yes, I think there is, we need to get over this fear psychosis. And lastly, I think, is the value, which I have been repeatedly telling. If you look at any parameters in terms of value, if you look at, price to book on the Nifty, for example, the price to book on the Nifty is something like 2.1 times. If you look at price to earnings, say, of the Sensex, the price to earnings Sensex against its long-term decadal average of 15.5 is closer to around 13 times now. If markets fall to 15,000 levels, it will be at 12, which is, I think, a significantly attractive level for anybody to start investing. And if you look at market cap to GDP, market cap to GDP today is just close to around 60-62%, which is almost at its Lehman lows, right? So if you look at, a large number of these valuation issues, I think valuations now are looking really attractive. If you look at the entire decade, I don't think we've seen, better valuations. I'm not saying that you may have a couple of, percentage points drop in the market, which will make valuations only that much more attractive. And I think two things will drive markets at the end of the day. One is the earnings, and two is flows. And both these, I think, are in favor of us at this point of time.
So let me just, spin it around with liquidity. So far this year, foreign institutional investors have pumped in about 40,000 crore and markets are up 6%. If I look at the May data, foreign institutional investors have not panicked. Nifty is back to 4,900. What if they panic?
What if there's capitulation? If you say, what if the foreign investors decided to take out their money?
Because we are a liquid market, we are still net importer of foreign capital. If because of global uncertainty, if risk off really gains some more magnitude, are we staring at more downside then?
See, the point very simply is that if you're looking at a black swan event, where, for example, there is a disorderly exit of Greece from the European Union, as you had initially mentioned, then it is possible that there will be people who will take out money from Indian markets. Are
you preparing your portfolios for that kind of a scenario?
See, if you look at our portfolios are at this point of time focused on, a couple of fundamental issues. One is we're taking exposure to dollar proxies.
Which is IT.
Which is information technology and pharmaceuticals. And we believe that at this point of time, the dollar proxies will do very well. Specifically with relation to IT, there is enough information and data to suggest that IT spends are not going to reduce dramatically as we go into next year, and they will remain at these levels, if not go up. As far as pharmaceuticals are concerned, I think the domestic demand situation is also very, very good, with an almost 18% year-on-year growth in domestic demand. So as much as it's a dollar proxy, it's a good play on the domestic demand. The second set of stocks which we play with in the equity in our equity portfolios is the consumption-driven story, and we believe that with private consumption remaining fairly steady, there is a great opportunity for us to sort of make decent money in consumption stories.
How exactly are you investing in consumption? Because it's a broad word. Some believe that the best way to play consumption is buy banks, some feel it's autos, and the third group feels that the best way to play consumption is to buy companies which serve consumers directly, which is FMCG.
Okay. So whereas we are looking at companies that serve consumers directly, I completely take your point that we are also looking at mortgage companies, because as you rightly said, these are companies that directly serve consumers, and I think housing needs are going to be a need that will remain with the Indian house buying population for a very, very long time. So we're looking at both of those. Thirdly, we are looking at oil marketing companies, especially some of the mid-cap companies, because in terms
oil marketing?
Yeah, the OMCs, because we do believe that from a valuation perspective, they have been beaten down, and they are pricing in today oil at something like 125 to a barrel. They still are pricing in oil at 125 to a barrel, where oil prices have already started correcting, and I think there will be a small opportunity out there. And in terms of price to book, they are now at very, very good valuations. We also have some exposure to the banking sector and the, the infrastructure financing sector. And there primarily because, again, from a valuation perspective, we think that it is a good opportunity. Today you have, many of the power financing companies that are at a price to book of, 1 time or less than 1 time. You have some of the private banks that are at 1.2 times price to book. Some of the, concerns in terms of asset quality seem to be overdone, and the results that we've seen in the last couple of quarters seem to suggest that, the asset quality deterioration isn't as bad as what the market is pricing in. So we see some opportunity out there, and we have, exposure in those kind of sectors.